Hey everyone, welcome back to Conviction Bet. Hope you're doing well. What a week it has been. The US is blockading Iranian ports. Missiles have been flying in the Persian Gulf. The UAE has been intercepting them. And the ceasefire is under significant strain, even as US officials insist it technically remains in place. The energy markets have noticed oil is sitting around $100 a barrel. And as a direct consequence, consumer sentiment fell to 48.2 inches, the University of Michigan's May survey, near its prior trough from mid-2022. And yet somehow, in the middle of all of that, the tape told a completely different story. The Nasdaq rose 4.5% for the week and closed at a record. The S&P 500 also hit a record, both helped by another wave of AI-driven tech earnings, which tells you exactly where investor attention is right now. It's not on the Persian Gulf, it's on the data center. And speaking of the data center, ARM Holdings just posted the best single quarter in its 35-year history. Revenue record, margin record, EPS beat. And investors celebrated then, spent the next hour selling on the fine print. 35 years. Best quarter ever. Investors sold it. But here's what actually matters this week. $1.49 billion in quarterly revenue, 20% year-over-year growth, 49% operating margin, 98% gross margin, the highest single quarter in the company's history. And on the same day, Uber, $53.7 billion in gross bookings, 25% reported growth, $2.48 billion in adjusted EBITDA, $2.3 billion in free cash flow. In a single quarter, the market is telling a story about a guidance step down and a backlog miss at ARM and a GAAP earnings disappointment at Uber. The real story is about two toll collectors, both of them in the same week, who announced they were going to start driving vehicles on their own roads, and whether that makes the road more valuable or less. I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. We're covering both ARM and Uber earnings this week, two companies in completely different industries facing the same fundamental question: can the company that owns the infrastructure afford to also compete on it? For ARM, there's a detail in the Silicon announcement that almost nobody is discussing, which is that this may not be ARM's first attempt to build a chip capability so much as the product of a corporate umbrella that now includes $6.5 billion of server CPU engineering talent sitting right next door. For Uber, the autonomous vehicle threat that everyone is certain will destroy the business is, at least in the markets where it's most advanced, currently producing evidence more consistent with market expansion than cannibalization. And the Morgan Stanley model that says the long-range outcome looks different is the one I want you to hold through to the conclusion, because it's the most specific and honest version of the bear case, and answering it is the only intellectually credible way to close this episode. Let's start with ARM. The quarter ended March 31. 2026 was excellent by almost any reasonable measure. Revenue of $1.49 billion, up 20% year over year, topped the analyst consensus. Non-GAAP earnings per share of 60 cents beat the consensus range. Non-GAAP operating income of $731 million produced a 49% operating margin. Gross margin held at 98%. For the full fiscal year, ARM crossed $4.92 billion in revenue, up 23%, marking its third consecutive year of 20% plus growth since its 2023 IPO. That is not a coincidence. It is a company executing a thesis. The investor reaction told two stories. Initial read after the bell was positive. Then sentiment reversed as investors worked through the details beneath the headline. Three things drove the reversal. First, Q1 fiscal 27 guidance called for revenue of $1.26 billion, a meaningful sequential step down from Q4. Second, management explicitly called for the mobile handset market to be flat to slightly negative in fiscal 2027. Third, and this is the one that moved investors, remaining performance obligations reportedly came in at $2.07 billion, down 7% year over year and reportedly well below street expectations, according to ARM's shareholder letter and analyst commentary following the print. Now, RPO is contracted revenue not yet recognized, primarily tied to licensing and services. It's worth flagging that RPO excludes future royalty revenue, so it is a useful but incomplete backlog proxy for ARM. Royalties are the fastest growing part of the thesis, and those don't appear in this number. That context matters. Management's explanation for the shortfall was faster revenue recognition, not slower bookings. And the supporting evidence is real. Annualized contract value grew 22% year over year to $1.66 billion. If you believe the accounting interpretation, the RPO miss is a timing story. But in a stock trading at roughly 100 times forward earnings, that interpretation is load-bearing. I'll be watching ACV growth over the next 2 quarters, not the backlog number in isolation. Now, let me explain the business because the valuation only makes sense if you understand what ARM actually is. ARM has always been the invisible toll road of modern computing. Every chip that ships into a smartphone, a cloud server, an autonomous vehicle, an embedded industrial system, if it runs on ARM architecture, it carries ARM's economics, not for manufacturing, not for design services, simply because the underlying architecture, the instruction set, the silicon grammar is ARM's intellectual property. The company has surpassed 350 billion cumulative chip shipments since 1990, and in 35 years, it has never built a single wafer. That business model is close to perfect in the way a toll road is close to perfect. 98% gross margins, no manufacturing risk, no inventory, no fab capital expenditure. ARM charges a small tax every time someone uses a sentence, and 22 million developers globally are writing sentences in ARM's grammar. Switching away requires rebuilding software stacks that took years to construct. The moat is not a feature. It is the ecosystem itself. But in March 2026, ARM announced it was going to build a road. The AGI CPU unveiled at the ARM Everywhere event is ARM's first production silicon in its 35-year history, up to 136 Neoverse V3 cores manufactured on TSMC's 3-nanometer process, designed at a 300-watt thermal design power. And I want to pause on the name for a second. AGI CPU sounds like it's related to artificial general intelligence. It isn't. ARM frames AGI here around agentic AI infrastructure, the computing fabric needed to support autonomous AI agents, not the science fiction endpoint of machine superintelligence. ARM clearly chose the name to evoke the broader AI narrative, which is fine. It's working. The positioning is specific, not a general-purpose server CPU competing against AMD's EPYC or Intel Xeon. The head node CPU for agentic AI workloads, the orchestrator sitting next to the accelerators and managing data movement, task scheduling, memory hierarchies, and security enforcement. CEO Rene Haas said on the earnings call, as AI moves from human-based queries to continuous agent-driven workloads, the CPU layer becomes the pacing element for scaling the entire system. And his projection stated explicitly is that data centers will require more than 4 times today's CPU capacity per gigawatt as agentic AI scales, creating a market opportunity of more than $100 billion by 2030. He was also direct about what the demand signal tells him about his own prior thinking. On the earnings call, Haas said, and I'm paraphrasing the substance closely, I think one thing we know for sure is that we probably have undercalled the CPU demand in terms of the transition here. That is a CEO saying his original model was too conservative based on what he's actually seen in the market. Meta is co-developing and committed as launch partner. OpenAI, Cloudflare, and SAP are in the launch set. SAP is also in the customer set, building on prior ARM-based infrastructure work with AWS Graviton. Since the March announcement, 6 weeks before the earnings call, customer demand has already exceeded $2 billion across fiscal 27 and fiscal 28. More than double the $1 billion projection from the launch event itself. Now, here is the part of this story that almost nobody is talking about. In March 2025, SoftBank, which owns roughly 90% of ARM, announced it was acquiring Ampere Computing for $6.5 billion. Ampere is a semiconductor company that designs high-performance, energy-efficient processors for cloud and AI workloads. It employs approximately 1,000 semiconductor engineers. The deal closed in November 2025, 4 months before the AGI CPU announcement. Industry analysts widely believe that Ampere's engineering team is contributing to future AGI CPU generations. The roadmap reportedly shows an annual development cadence, with a second-generation chip likely on TSMC's 2nm process already in development. The hypothesis is that Ampere's efficiency in parallelism DNA will matter most for those future generations. Here is why this matters. SoftBank now owns ARM and Ampere under the same corporate umbrella, giving the group access to a server CPU engineering bench that ARM itself historically did not have. It also owns a significant stake in OpenAI, one of the AGI CPU's launch customers. ARM is not doing this in a vacuum. The $6.5 billion acquisition of Ampere 4 months before the AGI CPU announcement looks a lot less like a coincidence in hindsight. Let me explain why the existing IP business is the more durable part of the thesis, and why the royalty story is structurally more powerful than it appears. NVIDIA's Vera CPU ARM architecture, Google's Axion ARM architecture, AWS Graviton ARM architecture, 3 of the most important AI infrastructure stacks in the world are building their companion or head node CPU layers on ARM. These are multi-year, multi-billion-dollar chip tape-out decisions that lock in architecture for 2 to 3 years at minimum. The royalty mechanism that makes this structurally meaningful: data center chips carry materially higher per-chip royalties than mobile chips. ARM v9 carries a royalty rate roughly 1.5 to 2 times that of ARM v8. CSS compute subsystems carry an even higher rate than standard CPU IP. 2 CSS license deals were signed in Q4 alone, one for smartphone chips, one for data center networking silicon. As the mix shifts from smartphones to server-class silicon, the weighted average royalty per shipment rises structurally. That is why data center royalty revenue more than doubled year over year for the 4th consecutive quarter, and why management expects it to double again in fiscal 27. Here is the revenue capture math that makes the silicon move so significant. ARM's traditional licensing model generates roughly 10 cents to $2 per chip, depending on design complexity. A complete data center CPU sells for thousands of dollars. By moving up the value chain from IP licensing to finished silicon, ARM dramatically increases its revenue per unit by potentially 2 to 3 orders of magnitude. That is the arithmetic behind the $15 billion fiscal 31 AGI CPU revenue target. Management's long-term targets, and I want to be precise. These are targets not confirmed. Forecasts call for $15 billion in AGI CPU revenue by fiscal 31, alongside $10 billion in IP revenue, for a combined $25 billion in earnings per share above $9. Supply is the binding constraint between here and there. ARM management was specific on the call. The bottlenecks span wafers, memory, packaging, and test equipment, the full production stack, not just TSMC capacity alone. As a new entrant to merchant silicon, ARM does not have the foundry relationship leverage that Apple or NVIDIA carry. That constraint is real. It is also not permanent. TSMC is expanding 3nm capacity, and a new fab is expected to enter mass production in the first half of 2027. ARM's position in the queue improves as capacity grows. Now, here is the tension I want to name clearly before I move on. The script I laid out has 2 claims that can sound like they're in conflict. The AGI CPU is optionality, and at roughly 100 times forward earnings, the math only holds if the silicon business delivers. Both are true, but they operate on different levels. Operationally, the AGI CPU is optionality layered on top of a royalty engine that already works. Valuation-wise, it is not optional at all. The stock already prices in meaningful success. Pause. That is not a contradiction. It is an honest description of the risk. The royalty business survives if silicon stumbles. The valuation does not. I have to be honest about the legal backdrop before I move on. ARM sued Qualcomm in 2022, alleging breach of architecture license agreements tied to Qualcomm's acquisition of Nuvia. In December 2024, a jury sided with Qualcomm on the central questions. In late September 2025, a U.S. District Court judge issued a full and final judgment in Qualcomm's favor, dismissing ARM's remaining claims and denying the request for a new trial. ARM lost round one, decisively. Qualcomm has its own separate lawsuit against ARM, alleging ARM is withholding deliverables under their existing license agreement, interfering with customer relationships, and this is the sharp part, using its IP position to advantage its own silicon ambitions over those of its long-standing partners. Qualcomm amended the complaint to specifically add allegations about ARM's intent to make and sell its own chips. After its late September 2025 victory, Qualcomm said it expected a March 2026 trial in this separate case. The current procedural status should be verified before this goes to publication, but the case was live and adversarial as of the most recent public filings. The point is not that these proceedings will cripple ARM. It's that the transition from IP licensor to silicon competitor is being legally challenged by its largest and most important licensee in real time. The ecosystem trust that makes the IP business invulnerable is precisely what the Silicon move asks investors to believe ARM can maintain. Every partner ARM asked at the ARM Everywhere event reportedly said yes. Qualcomm's legal team filed a different answer. Watch it. But that's only half this week. Let's talk about Uber. The headline numbers looked messy. The market liked what it found underneath. Revenue came in at $13.2 billion, a 14.4% gain year over year, marginally below the consensus. GAAP earnings per share was 13 cents, down from 83 cents a year earlier. On the surface, both look like misses. Investors responded positively anyway. Here is why each headline misleads. The GAAP EPS shortfall traces largely to a $1.5 billion pre-tax mark-to-market headwind from Uber's equity investments non-cash accounting that reflects changes in the valuations of stakes. In companies like Didi and Grab, it tells you nothing about the operating business. The analyst consensus was built on non-GAAP EPS. On that basis, Uber delivered 72 cents a beat and up 44% year over year. The revenue miss has an even more specific explanation. Business model changes structural accounting reclassifications where costs previously counted as revenue are now netted against it. Reduced total revenue growth by 9 percentage points. 9 points. On a 14.4% reported growth rate. Under prior accounting treatment, revenue growth would have printed above 20%. Remove the accounting noise and you find a business performing at one of the highest levels in its history. Gross bookings, $53.7 billion, up 25% reported and 21% in constant currency, beating consensus. Adjusted EBITDA, $2.48 billion, up 33% at a 4.6% margin of gross bookings. Free cash flow after $65 million in capital expenditures, $2.3 billion in a single quarter. And then Q2 guidance, gross bookings of $56.25 to $57.75 billion, constant currency growth of 18 to 22% above street consensus. Non-GAAP EPS of 78 to 82 cents, implying 31 to 38% growth year over year. When a company slightly misses Q1 revenue on accounting mechanics and then guides Q2 above consensus, the message is clear. The trajectory is intact. The so what? The GAAP headline is not the story. $2.3 billion in free cash flow in a single quarter against $65 million in CapEx. That is one of the strongest cash conversion profiles in consumer-facing technology. Now, here is where it gets interesting. Think of Uber as a toll road. Toll roads don't care what kind of vehicle uses them. A taxi, a rideshare car, a delivery van. They collect a fee per transaction and they benefit whenever traffic grows. Uber's 199 million monthly active users, its logistics infrastructure, its insurance programs, its global regulatory relationships, these are the road. What Uber is becoming, more precisely, is the distribution layer, the fleet orchestrator, and in some cases, a partial financier for autonomous vehicle operators who need utilization and customers more than they need another app. The critical question is whether that position is durable, whether AV operators will continue to need Uber's road or eventually conclude they don't. Here is what the data actually says. In Austin and Atlanta, where Waymo launched no driver rides on the Uber platform, management said launches were performing strongly and Uber's position remained healthy. In San Francisco and Los Angeles, where Waymo has been operating longest, where the AV threat has had the most time to develop, Uber's category share was reportedly higher at the time of the Q1 call than it was 6 months earlier. And autonomous vehicle trips on the Uber platform grew more than 10 times year over year in Q1. The company is currently live with AVs across 8 cities, with management expecting expansion to as many as 15 by year end. The early evidence is more consistent with market expansion than immediate cannibalization, though it is not yet conclusive. Deutsche Bank published a note in March calling Uber the long-term winner, arguing that AV operators need Uber's utilization and demand infrastructure to be profitable. MoffettNathanson published a 21-page report at almost the same time with a more cautious read, describing Waymo as beginning to pose a genuine competitive threat. 2 serious research firms, same data, opposite conclusions. That tells you something honest about where the thesis actually stands. The AV partnership list tells the story of a company trying to be the infrastructure layer for all of them simultaneously. Waymo, Zoox, Amazon's AV unit, Rivian, Pony.ai, Wabi, WeRide, Motional, NVIDIA across 28 cities, Lucid, and Nuro. The strategic reason AV operators may choose Uber's platform is straightforward. 199 million monthly active users represent a customer acquisition cost that would be prohibitively expensive to replicate from scratch. The road is valuable not because it owns the vehicles, it's valuable because it owns the riders. The operating business is compounding across 3 specific dimensions while the AV story plays out. The mobility segment, ride-hailing, generated $26.4 billion in gross bookings, up 25% reported and 20% in constant currency. Adjusted operating margin of 7.7%, up 20 basis points year over year. The mechanism is a deliberate barbell. Premium products, Uber Black. Comfort electric and low-cost products, Uber X. Share, shuttle, growing simultaneously. Average spending per user is 3.5 times higher in the premium tier. Usage frequency is 75% higher in the low-cost tier. Build both ends, leave the middle to competition, improve unit economics through mix. Delivery posted $26 billion in gross bookings, up 28%. More importantly, delivery revenue grew 34%, materially faster than gross bookings because the take rate expanded to 19.5%, up 96 basis points year over year. Advertising is the driver. Restaurant partners and consumer packaged goods companies buying placement on Uber Eats, revenue that flows nearly straight to the bottom line. And then Uber One, 50 million subscribers, up 50% year over year, generating roughly half of mobility and delivery gross bookings, retention materially higher than non-members. The program now covers ride discounts, delivery, grocery, and hotel bookings, with credits returning a portion of hotel spend. Cross-platform users spend and retain at significantly higher rates than single-platform users, and the gap between what Uber's platform could capture versus what it currently does in cross-selling between mobility and delivery users remains a meaningful, unrealized opportunity. That gap is what the Uber One subscription is designed to close. The so what? Uber is deepening the platform in every direction simultaneously. The subscriber base is stickier, the take rate is expanding through advertising, and the AV trend is adding trips rather than replacing them, at least for now. The question is not whether the business is good. The question is whether the AV market stays platform compatible or consolidates into something that eventually has no use for Uber's road. And I know what the bear cases are. Let me give them both to you fairly. For ARM, the real bear case is 2 things working simultaneously. First, execution risk on silicon. Merchant silicon requires supply chain relationships, customer support organizations, yield management, and direct competition with companies that have been doing this for decades. The AGI CPU team is reportedly tens of people credible for current scale, but the demand signal has already run ahead of the supply chain capability. Second, and more pointed, Qualcomm's lawsuit against ARM specifically alleges that ARM is using its IP licensing dominance to hinder licensee innovation while better positioning its own products. These are live allegations, not findings, but if proceedings produce unfavorable licensing terms, the royalty structure on which the entire thesis is built becomes much harder to defend. And the ecosystem trust that makes the IP business invulnerable is exactly what the Silicon move puts at risk. ARM asked every partner for their support at the ARM Everywhere event, and everyone said yes. Qualcomm's legal team filed a different answer. That is a legitimate concern. Here is why the bull thesis survives it anyway specifically. The IP royalty business does not depend on the AGI CPU succeeding. It depends on ARM v9 penetration continuing to rise and data center royalties continuing to grow, both of which have clear, current, verified momentum. NVIDIA, Google, and Amazon have committed to ARM architecture for their AI CPU designs. Those are multi-year decisions that don't unwind on a quarterly cadence. And remember the distinction I drew earlier. Operationally, the AGI CPU is optionality layered on top of a royalty engine that already works. If the silicon business stumbles, the royalty engine does not stop. The valuation is what breaks, not the business. For Uber, the bear case is a specific technology outcome. Waymo and Tesla achieve sufficiently dominant AV market positions that they have no incentive to distribute through Uber, bypassing it for their own customer-facing apps. Right now, Waymo is operating hundreds of thousands of weekly rides across 10 metro areas, targeting 1 million weekly paid rides by the end of 2026. Tesla remains in limited early deployment. GM's Cruise, worth noting, effectively collapsed after safety incidents in late 2024. The competitive field is thinner than the narrative suggests. But the long-range model that most bears cite is worth taking seriously. Morgan Stanley's projection is that if Waymo and Tesla operate a meaningful portion of trips through their own apps and Tesla does not cooperate with Uber's platform, Uber could capture only 22% of U.S. autonomous driving trips by 2032 versus its roughly 70% share of current ride-hailing. That is the most specific and uncomfortable version of the bear case. It doesn't break the near-term thesis. It is a 6-year terminal value question. And the reason the stock trades at a discount to near-term fundamentals, even with record free cash flow, is precisely because that question does not have a clean answer yet. That is a legitimate concern. Here is why the bull thesis survives it for now. The Morgan Stanley model is a scenario, not a forecast. It assumes Tesla doesn't cooperate. It assumes Waymo and Tesla both build standalone consumer networks that are cheaper to operate than using Uber's distribution. Both assumptions may prove correct, but neither has materialized in the markets where AV deployment is currently most advanced. San Francisco, Los Angeles, Uber share went up. The economics of AV deployment today favor platform distribution. When that calculation changes, the thesis changes. Watch for Waymo or Tesla publicly reducing their Uber partnership volumes while growing standalone app traffic that is the tripwire. It hasn't fired. Let me bring this back to where I started. 2 toll roads. One built on intellectual property. Every chip running on ARM architecture pays a royalty. That royalty is rising structurally as the mix shifts toward data center. And the corporate umbrella now includes a server CPU engineering team acquired specifically to help ARM compete in silicon while the royalty engine keeps running. One built on physical infrastructure, every ride, every delivery, every grocery order, every hotel booking routes through Uber's demand engine, and the subscription model is making the routing stickier every quarter. Both companies announced in the same week that they were going to start driving vehicles on their own roads. Both raised the same question. When a toll collector starts driving, do the existing drivers pay more or find another road? The early evidence says pay more. The risk is that changes. And in a week where missiles are flying over the Persian Gulf and the Nasdaq is closing at a record high, that question about infrastructure, about who owns the layer that everything else runs on, is the one that will actually determine your portfolio returns over the next 5 years. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's quietvelocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.